All right, I got through the 900 different Google verifications, so we're good to go. All right, good morning, everybody. We're getting a little bit of a parabolic move this morning, like a blow off top. It's going to become a little bit unsustainable, I would believe. One of the biggest things you can see using FX Street is non-farm payrolls. I've often talked about these pre-market candles that we get where it's like a liquidity vacuum and we get this gap. And a newer trader, they're not going to see a gap because there really are candles there, but it's a liquidity gap. Today's one of those days where we could get this gap set up. All right, so we got a little bit of a rotation going on. We've got crude, metals, mining, energy, and consumer goods. So more of a rotation out of that tech. I say that, but we can still see here Apple closing in a record in NVIDIA rising another 5%. So this was yesterday. And this is what's happening in the overnight. So we want to see if we're going to carry that rotation into today. It's a little bit of a chicken and an egg, right? Like which come first, the chicken or the egg? With this, sometimes our markets affect the global market space. And then other times the global market space affects our markets. So our tech run from yesterday didn't carry over around the world. And instead what we saw is goods and services, precious metals and mining, those reflation trades. And now we want to see if we're going to keep that through our session or if we're going to go back into tech again. Volume's not as light as I would have anticipated this morning with it being non-farm payrolls. I really thought it was going to be a lot lighter than this, sitting at 100 is fine. It's not too big of a deal. If we were, say, sitting in the 70s, then that would be, a bigger deal. Another thing is we have a market maker move this morning. So that implies they're looking for a big move, that they are hedging against a big move. But the volume's actually in more than I had thought it would be. See, yesterday when we had 88,000, right? So this move that I was referring to a little bit ago, this gap close play, I've done videos on this kind of after the fact where I talk about it in the morning briefing, and then later in the day it all unfolds. I've done a couple of those videos. It's worth taking the time to do this morning, because this is absolutely on the table, and we don't get the opportunity to do this trade every day, right? It's mainly 2 or 3 times a month. CPI, maybe PPI, and then non-farm payrolls. So what we're looking for is one of those days where we had a pre-market briefing on an event day. Seems like Thinkorswim is still trying to get all my days here. Still jumping. I'll just give it a second. So while we're letting this thing correlate all those days, we're going to look for a very clean candle spike, right? We don't want a multiple direction candle spike. We want it to be just straight up or straight down. That's one of the criteria. And the second is you actually want to see this turn and go the other way. You don't want to assume that it's topped out, and you don't want to assume that it's bottomed out. So here's one of those days, one of those examples. If you want to find the day for yourself and look at it in more detail, this is December 13th in the morning session. I'm on a 15-minute chart because on Thinkorswim, you can only go back so far on a 5-minute chart before you can't go back anymore. At 8:30, the report came out. We had an explosive move to the upside, and then this market spent the rest of the day coming back down to where the move started, closing the gap. And I know you don't see a gap, right? You see candles. What gap? But it's a liquidity gap. The market really wants to close this. And I'm not going to say that it always closes it every single time in the daily session after the move happens. I'm not saying that, but more often than not, it does. In fact, the last few times that I've pointed this out, it has gone and closed the gap. So it's worth paying attention to. But what you don't want is one of those mornings where it goes both directions, right? Something really sloppy where it spikes really high and it drops really low, and then it kind of wobbles around and closes somewhere in the middle. You don't want that. You don't even want it to spike both directions and close somewhere on one side or the other. You want a clean drive just like this. Notice how it went in one direction immediately, and it didn't try to go down first and then change its mind and go up. It just went up. There's no wick on the bottom of that. The cool thing is you can Google when non-farm payrolls was in the past, and you can look at old CPI days and old PPI days, and you can research this for yourself. Go back to those days, look at the big move that happened, and then see if we closed the gap afterwards. What you're going to find is, yes, we did way more than is statistically probable, right? So it's in your favor to look for this one. It is the most dominant thing on the agenda now that we're past the debt ceiling issue, right? This is going to be the next thing. There's a lot of talk about a skip, which is kind of funny. So they're not talking about a pause. in their rate hike regimes, they're talking about skipping. So if you were doing something and then you call timeout and you quit doing that for a little bit, you can call it whatever you want. A skip, a pause, whatever. So everybody's looking at the data that's coming in, trying to determine if there is going to be a pause or a skip or whatever you want to call it, or if they're going to hike anyways. The data that we get today will feed into that narrative. So this is one of those data points that's really important to the big picture on answering that question. We are inside day breakout. And we have an MDP. So we have not hit the daily pivot. We broke out of last week's high. So we're on an inside week breakout and we're on an inside day breakout with an MDP. We're getting a little expanded. I know, right? But is it new? Is it new that they're playing these word games, or are we just maybe a little more present to it? Right? Remember, to kind of refresh your memory, when they were thinking about having the discussion of maybe kind of sort of, you remember that language? I hated that stupidity. Listening to grown-ups on Bloomberg talk about thinking about, having a discussion about, thinking about what? You know what I mean? Like that's just that kind of language. So maybe they are kind of increasing their shenanigans a bit more. But clarity of the message is something that they strive for, right? They don't want to surprise the market. That's at least that's what they say, right? That they don't want to. So what we're looking at here, 10-day, 30-minute volume profile. When we're at the bottom, we expect to go to the top. When we're at the top, we expect to go to the bottom. We don't really have a classic shape. If we were to try to discern a shape out of this, I guess it would be a P. Capital letter P. We definitely have the P shape on the TPO. And right now, the point of control for the volume profile and the TPO are really close together. All right, 5 by 5. We took out that VPOC, so we don't need this one anymore. And we took out that one, so we don't need that anymore. I should have kept it. So we got a VPOC underneath this from yesterday. 42.26. And we're kind of running out of space. There was some statistics yesterday, or maybe not statistics, but some numbers that were pretty interesting. Where we are sitting at the close yesterday is where we were sitting back in February. That would be on the S&P. Right, so February 2nd, somewhere right around in here, Yeah, right there. And where we closed yesterday, or well, we drove through yesterday, same price location. Back in February, more than 75% of the S&P was above their 200-day. Now 38% is above their 200-day. So we lost a ton of breadth, right? If we consider breadth, the number of companies that are our focus, right? When we go into advanced decline, and we're looking at advancing minus declining issues, things like that, breadth. 75% were above their 200. That's strong, bullish. And now only 38% is above their 200. And yet we're sitting at these nosebleed heights, implying that we got there with just a few names. But that's not a surprise, right? Everybody and their cousins, brothers, uncle has talked about we're at the location that we are because we got carried by 5 names or 7 names. The thing is, what are we going to do with it after that? So with this market maker move on deck today, and with this potential for a squeeze, the more that people think we're going to go down today and try to short it and get caught in a trap and buy, we could actually get a massive rip to the upside today. The market maker move says we could go another 0.5%, and the ADR is 1%. So that's 1.5, but that's nothing. Just kind of take some of this stuff off for a minute. The ADR half is 42.80. We would want to add the market maker move to that. So another 0.5%. And that gets us up to 4,300. So a magnet to 43. Solid round number, all of that good jazz. The thing is, all of that would still be just another day at the park. It's not extreme yet. To go extreme, we would want to go even farther than that, right? So if we were to mark this out, that's the high side and the low side for the day, just using the market maker move and the ADR. If we were to get a little wild and out of control, double that move. 43.71 to the upside and 4,100 to the downside. And if you're thinking I'm reaching, I haven't even begun to reach, right? This is not extreme yet. This is only mildly beyond the measured move. Now, the only thing that would discount a move of this size is that half of the trading day is already done. The trading day started yesterday at 6 o'clock. We're past 6 o'clock this morning, and that means half of a 24-hour period is done. So we would be looking at making a move of this magnitude with the small amount of time that we have remaining. And we're still only looking at 3%, right? I'm kind of averaging here. Okay, 2.25%, 0.75%, 2.75 from our current location. And we can easily move 2.75% when we're only up 0.5% this morning. to be able to get a move of that magnitude, we need something to get us there. All right. So what do we got this morning? Providing fuel for the fire. We've got bonds, China ADRs, energy, Bitcoin names, semiconductor names, financials, precious metals. I said bonds, but no, take that off the list. So we got all of that. That's nearly every single one of the target points that we would hit on anyways. All right, so this is my homemade little FANG index. And we can see that the FANG names are also up this morning. So we have those as well, big tech. That's everything on the list. So when we think about risk on, risk off, the risk on sectors, finance, technology, consumer discretionary, we got all three of those. Tesla drives consumer discretionary, and Tesla is up this morning. So every box is checked for this to be a continuation of bullishness. The only thing that's mildly concerning is what's going on with yields. And we wanted them to go down, right? We needed them to kind of get back into the box. We got that. All right, we still got VIX heading to the downside. It's underneath 16 now. We're at 15, below 15 and a half. So we're getting down into levels that we haven't seen since COVID, since before COVID. I need to say it that way. Like I said, I'm gonna have to take that back. We got down to 1410 in June of 21. When we talk about hedging or protecting your portfolio, and the cost to buy insurance, say it that way. Well, right now, the cost of insurance is cheaper than it has been since July or June of 2021. So it's on sale. Insurance is not a payday, right? You wouldn't burn your house down just to get a check. It's more of protection so that if your house does burn down, you do get a check. So with that in mind, when you can pick up a little extra insurance on the cheap, you may as well do it, right? And it doesn't have to be crazy expensive insurance, but you do get what you pay for. So with this carrying the narrative of that theme, if we were to come in and look at, say, buying an option at the money versus buying an option out of the money, one is going to pay you better than the other. and one is going to cost more than the other. If you go, we'll just use $20. You go mildly out of the money, $20, a 20 strike call is not that far away. But you're going to need a good move to get there. And it's still going to cost you $250. Kind of split the difference. It's going to cost you about $255, $257. That's $257 that you're spending with no expectation of profit, right? Because we don't use these for trades. We're just using these for a hedge. What I want to caution you against is what I've been seeing a lot of people do when it comes to hedges with the VIX, is they just go way out here and buy this cheap stuff. I mean, look, you can get 35 strike call, 45 cents. That's cheap, right? But you would need the VIX to move crazy big to make this one pay. It's going to need to be one of those crazy moves that takes the market down for days and days and days, not just a one-day spike. So, you know, if you go that far out of the money, you're nearly going to need a COVID style move in the market to get paid. That turns your insurance into disaster insurance, that it has to be something so extreme that it's affecting global markets just for that thing to pay you. So that just seems like a waste of money, right? So when you're thinking about the hedges and how much you're going to, you know, spend, just kind of keep that in mind. You really do get what you pay for. That's one. And then the other is, what's it going to provide for you? Or how likely is it that it's actually going to pay you anything at all? I would rather put the trade on at the money and just use the spread, right? Because with the spread, we can control the cost to a degree. And putting it on at the money doesn't require as much of a move. That's an inappropriate cost. Whatever the size of your spread is, look for half of that in your cost. No way I'd pay $75 for a $1 wide debit, but you know, the market's closed. These are inappropriate values. They're not reflecting the actual cost right now. But an at the money, this would be a 50-cent trade. And if I wanted to increase, then I can just make the thing wider, or I could add more lots. Simple as that. All right, SKU's getting up there. Right now, we're looking at a chart that goes back to 2018, and you can see how often we've been above that 155 level. Okay, counted on one hand, even my hand with missing fingers. So we're getting up into this rare space that we don't often get to. And to provide a little bit of a backdrop behind that, this purple line is the S&P. So when we topped out here in SKU and we started to fall, the S&P just kept right on going. Don't think that it is going to correlate with some, you know, immediate reversal. The same thing with this low, when it had this classic double bottom in the S&P, and then we ripped up, this was still heading to the downside, right? This wasn't done, and it wasn't reflecting this move back. So it just provides a little bit of context, right? The difference is the last time we got this high or this extreme in the SKU we were sitting at all-time highs in the market, and it had been this runaway freight train, not all-time highs. So we got COVID, the drop, the recovery, and then the run. And through all of this move, SKU was getting right up into that high. Well, now we got SKU getting up into that high, but we're still sitting inside of our own trash. Right? There's the drop. There's all of last year's bear market, the August high. So the S&P, is nowhere near in the shape that it was in back then, and SKU is getting really close to being at some extreme levels. So we just got to warn, right? Very cautious. Don't get complacent with the moves that you're seeing in the market right now. This tech run, as much as everybody keeps thinking it's going to end, that it has to end, that we've done enough, it doesn't have to end. It can just keep on going and keep on going. And so, you can try to assume that we're done and we're going to flip now, or you can wait for confirmation and then start to trade it. And until we actually start to turn, I wouldn't try to trade the turn, right? Think of it this way: if we are going to fall, we've got a long ways to go, right? We can fall all the way back to 3,500. We could even just get a mild fall back to 3,800. Either way, if we're going to fall, there's plenty of room. So you don't have to jump the gun and get in early and believe that there's a turn before there is a turn. You can just wait for it to start to break. And one of the things that you'd look to break is this low here, 40.50. If we break 40.50, then we're headed to 38.50. We break 38.50, then we'll head for 35, right? 36, something like that. So we got levels and ranges that we can focus on, signposts and goalposts that we can lean into. Otherwise, this really is starting to look a little bit like a blow off top, and that is bearish. We've got these really stretched out rising wedges, and rising wedges break to the downside more often than not. All right, KWEB is up 3.5%. KWEB ties in with those China ADRs. So you're thinking BABA, JD, PDD, those kind of names. And certainly we got BABA up this morning, inside day breakout, real big gap. Same thing with JD. I believe all three of these, or all of these, are going to have that same setup. So for PDD, this is a TRB setup, trendline breakover, nice follow through on the breakout day. But I certainly don't like the way that yesterday looked. There we go. That was a weekly So big gap up on the TRB, a fade back, and then a rally. We're still trapped here. We got to get through 72.25. I would just use this wick here on the intraday because it's not showing up on the daily. Call it 74.30. It's way up here. For a long, that would be my target. The concern is as we get into 8:30 and we're going to get our data, that the market is going to ignore anything else. It's going to ignore pivots, measured moves, price patterns, and it's all going to be flow. And nothing else is going to matter but that flow. So that kind of leaves us just watching the clock. We can already see the rip, right? We've got everything here primed and ready to go for a continuation. It's worth noting that if we're going to start to turn, if we do fall down today, you want everything, just like you have everything right now. You want to see everything start to fall together, because right now you have everything moving up, from Bitcoin, China ADRs, semiconductors, technology, finance. You got it all. So we want to see the opposite of that. Otherwise, individually, semiconductors can hold us up today. Tech can hold us up today. Finance could hold us up today. Individually, any one of those three could do it. So we don't want to get held up by one of those. We want either another ripping rally to the upside, which would be really, really rare, or a retrace and a dump. The thing is, it doesn't owe us either one of those. So something to keep in mind, it might and it could just stay right inside the range that we have set now, our Globex high and yesterday's low. We could just stay there for the rest of the day, not getting a big and extreme moves at all. So really something to think about there, right? For next week, you can see how much smaller the box is. So this is the week that we are in. And even though it's not set in stone yet, we've got next week's projection. So we can set it there and look at the next week's projection. The volatility is much smaller next week. Our expected range for next week is much smaller. All right, US dollar Japan, you can see this sell off day 4 pretty much wraps it up, right? And now we've paused. Really want to be watching this, see if we're going to get a continuation today. We're looking for an inside day breakout to the downside. Really don't want to see a breakout to the upside, but look at those wicks across the top. Certainly a lot of sellers up there, right? So I wouldn't mind testing that theory. I'd like to see this kind of run up and get a lot of selling pressure and then come back down. Really don't want to see it break that 138.5, but at least come down and test it, see if it, is going to be any sort of help at all. If we look at it on the weekly, it's still really bullish, right? Nothing Nothing's changed yet. This is just a pullback. We'll see if it starts to get out of control like it did last year. And then if they're going to come in and do any sort of intervention. And yeah, that was the October. Think about the S&P and where we bottomed out in the October lows before that crazy rally that we had last year out of those October lows. Well, that was the intervention here. So we want to keep our eye on this today. If we get a breakdown below 138.43, we're going to expect a strong breakout continuation. Gold, precious metals, silver, miners. We do have an OPEC meeting today, so energy is going to be front and center. So far, it's up 2% today. Nice continuation from yesterday. I would be watching this one close. If it dumps, it very well could be a catalyst through the rest of the market. I know we generally focus on technology and finance, but energy has much more strength as a market cap, much more weight, let's say it that way, to throw its weight around than it did, say, pre-COVID, right? So we can't just ignore energy like we would have 3 years ago. I think this dropping as fast as it ran yesterday would be a significant tell on the market. So kind of glance at it from time to time today. We ain't gonna stare at it all day, but you know, between TNX, TLT, the VIX, UVXY, maybe just kind of glance at this from time to time, make sure it's not getting out of control. And we still got this crazy moves going on in the dollar, right? Where it closes very close to where it opened, creating these dojis. I have never seen anything like this. Once in a while wouldn't be that bad, right? But this many in a row, this is statistically impossible to be a natural phenomenon. It's happening deliberately. But I don't know what it means. Not even a little bit. I have no idea. But this isn't a natural process, right? It's not happening on its own. All right, now keep in mind that discussion of the pivot that I had talked about, right? We're going to look for a very clean candle push up or down. And then we want it to prove that it's done moving in that direction, form a base, turn around, and begin closing the gap. The gap close usually takes a couple hours, right? We get it closed somewhere around 10:30, 11:30, something like that. So you got plenty of time. No reason to try to jump the gun and jump in to run this thing for a gap close within the first 10 minutes. You got plenty of time. May 10th. There's the 10th. So here's May 10th, 5-minute chart. You can see the CPI report came out when price was way down here. We had this explosive move, and then we paused, formed a topping pattern, and we spent the rest of the day working our way back down there and getting the gap closed. Then we had a really nice double bottom that failed, expanded with a measured move down to here, and then ripped it all back up again. Perfect measured move, by the way. So that was CPI day on the 10th. We can go to April 12th. If I can get back that far. I can only do 90 days. There it is, the 12th right there. So CPI day, 8:30, we get the report, get that explosive move, spent the rest of the morning coming back, getting it closed, and then perfect measured move, break down below it and rip right back up again. So I'm not cherry picking my days, right? I just did the last two. I can't go back on a 5-minute chart more than 90 days. But there's non-farm payrolls, CPI, PPI, those are three. And, you know, maybe PPI is more of a dud sometimes than not. So not necessarily one of the higher ones that I would put on the list for this kind of activity. And then, of course, March 14. I didn't have to look that one up. Now, see how sloppy this is. This is March 14, CPI day. We didn't get a clear candle. We got this sloppy indecision candle. So if this is the kind of candle that we get today, don't try any of this gap close stuff, right? Forget all of that. Don't try to trade it. Trade something else. Here's the February. Same thing, big sloppy candle, moves in both directions. Forget about it, right? Just do something else. So if that's the kind of candle that we get today, you don't want it. Cool. You got about 7 minutes before the report comes out. Everybody be careful, be safe. Make some money.